Wait, you still think you need 20% down to buy a house? Yeah, no. That myth should have died with Blockbuster. And I used to work at Blockbuster, so it hurts me to say that. I recently sat down with a lender and broke down two of the most common loan types, conventional and FHA. He explains what actually matters when you're trying to buy your first home. We're talking credit scores, down payments as low as 3%, and why PMI isn't the monster you think it is. So if you've been sitting on the sidelines thinking you're not ready, you might be more ready than you think. Let's clear up the confusion.
You and I had a conversation this week that I thought would be a valuable conversation today. You said in talking to someone that you were talking about conventional loan, FHA loan, whatever, and whoever it was you were talking to gave you the impression that they needed 20% down on a house.
Yeah.
And your answer to that in talking to me was, I am surprised that people still think that.
It's crazy.
Yes. And I have mentioned that multiple times on videos that I've made. We've had it on this show multiple times as well. And it's just not the case. And that just, to me, I'm not trying to offend anyone when I say this, but it's ignorance of people trying to buy a house that just don't know. They don't know what they don't know. And so they hear things and they think, well, I've got to have 20% down on a house, and so I need to save up forever to get 20%. And it's just not the case. So with that in mind, Brad, I thought it would be valuable today to talk about the different loan options that people have.
Yep.
And, maybe pros and cons and differences between them. And so how do you feel about that?
Well, first I want to say that you could buy a home with less than 20% down starting in 1956.
Oh, so it's been a while.
Since 1956, when the PMI industry was created, you could buy a house with less than 20% down. 1956, folks. That's
so more than 50 years, you said.
More than 50 years. 50 years. I'm 1969. That's more than 60 years.
Yeah.
Right? So for the last 60 years, you have not needed 20% down to buy a house on a conventional loan. And people don't understand that it's because we taught, and maybe our friend Dave Ramsey has taught that, PMI is the devil.
Yeah.
And most people don't know how mortgages work. So a mortgage company writes a loan. It's insured by Fannie Mae or Freddie Mac, which means the mortgage company is going to service the loan. They have the risk in the loan. And Fannie Mae or Freddie Mac comes in if that house goes into foreclosure, and they're going to cover any debt that you have up to 80% of that loan. That's why it's 20% down. PMI companies were formed in 1956. The president brought 6 of the largest insurance companies together, said, let's make it more affordable for people to buy homes. We're going to create an insurance system that insures the bank up to 5% down. Now it's 3% down on a conventional loan first-time home buyer. A first-time home buyer, again, is anybody who hasn't bought a home in the last 3 years. So if you sell your house and you go live in an apartment for 3 years, you're a new virgin first-time home buyer. And those PMI companies now cover the bank between, 5% down and the 20% down. So the bank gets paid back, and then Fannie Mae or Freddie Mac pays the 20%, and they take it into foreclosure. All right. That's what that whole system is about. So it blows my mind when I hear somebody say, well, we really want to buy a house. I guess we have to go FHA because we don't have 20% down. That's insanity.
Yes.
How do we not know that?
I know that the first loan I had on the first house that I bought was FHA.
Well,
no problem. Actually, it was even adjustable. How about
that? Well, I'm still sitting on an adjustable rate mortgage that I wrote in 2006.
Okay.
And I've beat the market all but 2 years of those years. But that loan doesn't exist anymore.
All right.
Yeah. So my first loan was an FHA too, basically because my credit was what I'm going to call scratch and dent.
That's a great term.
Isn't it? Now, you never go into like an appliance store and they're like, let me show you the broken ones.
Nope.
Like, these are scratch and dent. Mm-hmm. So I had the credit of that, a bit looser, but I still was able to buy a house.
Now you're a winner.
Oh, yeah. My credit scores are much higher than what they were.
Nice. All right. Well, let's get into it. I don't know which one you want to start with.
What do you want me to start with?
Let's go with conventional.
Okay. Conventional loans, Fannie Mae, Freddie Mac loans.
Sure.
Anywhere from 3% down for a first-time home buyer. Second-time home buyer has to be a minimum of 5% down.
Okay.
You can never exceed a debt-to-income ratio of 50%.
Okay.
And what is a debt-to-income ratio,
Thank you.
people ask? That is, if you take your income, what you make per year in base income, unless you've been in the industry on your job more than 2 years, then you can add your commissions and overtime and bonus to that. You take that number, you divide it by 12. That gives you your monthly number. Take that number, divide it again in half, and that tells you how much you can have in debt. And that debt includes whatever your new house payment will be.
Okay.
So if you're a 50.1, can't afford the house.
Okay.
And something to know that's important is, the minimum credit score for a conventional loan is 620. If you have an 820, it doesn't let you circumvent the 50% debt to income ratio. Minimum down payment is 5%. But if you're going to put down 45%, it doesn't circumvent the 50% debt to income ratio.
Okay.
So I say in a mortgage world, there's 3 C's. Credit, you got to at least have the minimum. Capacity, that's debt to income ratio. And collateral, that's your down payment. And, everybody wants to try to tell me that they have more of one, so it should make them qualify. And I explain it this way. Kevin Hart. Familiar?
Hello, Kevin.
So Kevin is rich.
He is.
He's famous.
He is.
He's funny.
He is.
Girls love funny.
Many do.
But if he takes a really hot, tall model to the Kings Island, he can't ride the beast with her because he's just not tall enough.
Poor Kevin.
So you take those 3 things and kind of make that the bar of, I have to be taller than that to be able to purchase a house. So conventional loans, PMI, a lot of people are scared of PMI. It used to be expensive. It used to be hard to get rid of. Today, PMI goes away automatically when you pay your house down 7 to 78% loan to value.
So little background on PMI. You said PMI is up until you have paid off 20% of the
78.
house. Sorry, 78% of the house.
Goes away automatically.
It's not an extra payment. It's just
part of your mortgage
payment.
Yes.
So once you hit the 78% mark and you notify your lender, hey,
No.
just to remind them.
78%, no notification necessary.
That's good.
But here's the part that is necessary. If you've lived in your house for the last 3 years, it's grown in value somewhere between 8 and 12%. So if you've grown 10% 2 years in a row, you've grown 20%. Even if you've only paid down a few $1,000s, you now can ask for an evaluation. And now that you're over that 20% down, your PMI can be removed.
There you go. So once you get to that point of 78%, the PMI comes off of your payment, and now your mortgage monthly payment is lower because the PMI no longer exists.
Right. And if you got great credit and a low debt to income ratio, your PMI is going to maybe 0.25% or 0.35%.
It's not a huge amount.
No, it's not. And if you're putting down 10%, it's even less. I mean, I have a customer upstairs. They've got a $290,000 purchase price with 3% down. Their PMI is $36 a month.
Gee whiz. Yeah. Yeah. We've blown PMI to be this monster that, you know what? You don't have to put down 20%. You can afford the minimal amount that PMI is, and, just get it paid off.
How about I've had people pull, 30 grand out of a stock account that's made them an average of 13 to 14% over the last 24 months to save 0.25% only because they hate PMI. You hate PMI more than you like your own future, but that's cool. Do it.
Hey, do what you want to do. Okay.
What's another loan type that we could talk about?
Is there any more about conventional that we need to know?
Well, there's a lot of ins and outs of conventional, so a lot of people think appraisal's not a whole lot easier for a conventional loan than it is any other loan type. The house has to be livable.
Yeah, absolutely.
So you can't watch HGTV and watch those guys buy this crap house with no money and then have no money to rehab it and then turn around and be a millionaire the next 30 days after you sold it. Maybe the Christies can, but you can't. The Christies being that.
Oh, yes,
yeah.
I'm aware.
I figured if I said them, it'd put us in the algorithm and we'd get more views. Right. So, you've got to find a house that you can live in. FHA is a little bit pickier with peeling paint or
we'll get into that.
Floor coverings or that kind of stuff, but it's not that much different.
Conventional has floor covering requirements, of course.
As long as you have subflooring, you're okay.
Okay.
Yep. And you can have drywall that's finished but not painted, where FHA has to be painted. You have to have suitable flooring. That it doesn't mean that it can't look like, 4 people were murdered in the living room. It just has to be there.
All right. So the chalk outline on the carpet is okay.
Fine, even that giant, massive blood stain's good.
Awesome. All right. Well, conventional. Let's move on. FHA is probably, I would say, the next most popular.
Correct.
I might be wrong, but
No, FHA is your, a lot of people think, oh, FHA is a first-time home buyer loan. It's not. You just can't have two of them at the same time. Unless you have a 2-bedroom house and you have a daughter and a son, biological, of course, and then you decide that you shouldn't live in a house where your daughter and son have to live in the same bedroom. FHA will allow you to go buy a 3-bedroom house so those kids don't have to share a bedroom.
Huh.
It's a rule.
All right. So opposite sex.
Yeah.
So if you have 2 girls.
Yeah, you got twin girls. They're cool with being together anyway.
Okay. Well, just making sure.
Yeah.
Okay.
So that's a rule. Another rule, let's say you got transferred more than 100 miles from the house that you currently live at, and the housing market is such that homes aren't selling, you get approved to purchase a second FHA loan. I've done none of those in 28 years.
How is it determined your house isn't selling? What's the metric?
I can't answer that question because I've never had one done, but it's more of proving that now where you've been transferred to is more than 100 miles away. That's probably the easiest thing. I've got my house on the market. I've been transferred. It's not sold. Okay, we'll let you do 2.
Okay. So before I get into the next potential answer, is there a credit score difference between the different loan types?
Absolutely.
Okay, so let's back up conventional.
620.
620.
But you're not gonna do it if you're under a 680.
Okay.
Because the rate and the PMI goes up so much more that FHA is a more economical loan.
Okay.
FHA goes down to 580 for 3.5% down.
Okay.
FHA has no credit score limit if you are putting down more than 10%.
Oh, very nice.
So then it looks at credit. You can't have any lates on your housing in the last more than 2 lates on your housing.
450 credit score.
Not buying a house.
Somehow have cash and can put down 10%.
Well,
FHA is okay with that.
No, because they're going to look at your credit history as well. So if you have a low score, there's certain things you can't have. You can't have more than 2 or 3 housing lates in the last 24 months. You can't have more than a number of installment lates in the last 12 or 24 months. You can't have it, so many revolving lates in the last 12 or 24 months. So
450 credit score probably has multiple of those.
Exactly. Now, if you can get an if you get an accept through the DU system, we're in the weeds. You can barely see me. It's like
fast forward.
I'm in the weeds now. You can't see me anymore. There are some things that can happen, but don't count on it.
All right. So back to FHA. Lowest down payment for FHA is
3.5. Yep.
Where does PMI factor in for FHA?
There is no PMI on an FHA loan.
There isn't.
Well, no, because it's not a private mortgage. It's a government mortgage. So you have MI.
Okay.
So if you put down less than 10%, your MI is a 0.55% factor per month.
If I'm not mistaken, never goes away.
Never goes away.
Yes.
And you also have what's called an upfront mortgage insurance premium, which we in the business call a MIP.
Oh, all right.
And a MIP is 1.75% of your loan amount. So if it's a $100,000 loan, your MIP's 1.75 financed onto your loan amount, and then 0.55 on a monthly basis.
Okay.
You want to touch on down payments for both of those.
Oh, thank you. Yeah.
Because a lot of people call me and they go, hey, we want to build a house on a piece of ground with the first-time home buyers program.
Oh, okay.
So that means you can buy a house with 3% down conventional. So what most people are referring to when they say with the first-time home buyers program, they're mentally thinking, I don't have to put any money down, right?
Yeah, probably.
So when you look at the loan types, FHA, conventional, 3% down, 3.5% down, first-time home buyer, USDA 0, VA 0. Don't have to be a first-time home buyer for either of those. But everything else is a down payment. So when you're looking at the loan type, it's a down payment. But if you're using a program like, let's say, Indiana Housing is going to give you a grant for your down payment of the 3.5%. So you are putting down 3.5% on one of those loans, down payment assistance loans. It's just not your money. It's coming from the government. Indiana Housing, in that case, not really the federal government, but a local government. But you're also signing away some things when you do those.
Oh, yeah, you are.
One, I believe, I could be wrong. I'm going to say it even if I could be wrong. Someone can Google it and tell me if I'm wrong. But a realtor told me recently he was at a closing where the person was using Indiana housing. And instead of the payback of the grant being 5 years, I was told it's now forever, is what they said in that closing.
Excuse me?
Yeah, you have to pay it back no matter when you refinance or no matter when you sell the house.
I personally have seen 9 years as the longest one. That was a couple years ago, but
Yeah. Yes.
wow.
It's forever. 9 years falls under the Chenoa program.
Okay.
And that one's with interest.
Okay.
So if you pay it off within the first 9 years, you pay it back with interest. So let's say you got a $20,000 down payment assistance program through the Chenoa fund. You've lived in that house for 8 years. You may owe back my customer that was buying a house. The seller didn't know they had that payback. When they got the payoff, it was $53,000 and they no longer could afford to sell their house.
Oh boy, not good.
So when you're going into those programs, if you're trying to buy a house with no money down with some type of grant or some type of down payment assistance program, ask the specific questions. Hey, when rates fall to 3% in December, can I refinance? No.
Nope.
So that's important. You're also paying a little bit higher rate because of the down payment assistance. So borrow from your 401k or borrow it from a family member or a gift from a family member or work or something.
Last thing maybe about FHA.
Okay.
One of the things that often comes up with realtors is the preferential treatment of conventional versus FHA or VA, primarily having to do with appraisals. When an appraiser comes out, they're going to look over the property, probably do a walkthrough of the property. They're checking condition, making sure that it is livable. They're not an inspector, so they're not getting into the weeds, but they do look through the house.
Mm-hmm.
And they're also looking for comparisons of what they're seeing in person versus the homes that they see online, and then checking out photos and all of that.
Correct.
So that's what they're doing. Now, there is various stories that realtors have about an FHA appraisal gone bad because of what some might term minor things. Some might not term them minor things, such as you have 3 steps up to your front porch and there isn't a railing there. So the
Conventional is supposed to call that out too.
See,
If
and
it's
that's the
more
thing.
than so many inches.
I believe that appraisers in the last 4 or 5 years have let those slide, because honestly, I've never had that called out back in that.
I had a railing on a conventional loan for a front porch that was 36 inches above the ground.
Okay.
There's a number.
Yeah, there you go.
And
the
number's the same, conventional or VA.
There you go. So they're supposed to have a railing there. So FHA appraiser says you need to have a railing here, and someone needs to install that before they would finalize the loan. Same with chipping paint. Same with if you have a basement with rafters or the support beams.
What's that one? I haven't.
Having to do with whether sometimes people will take their basements and they will paint the joists and such.
Yeah.
And if the paint again is chipping or
only if that paint is deemed to be lead-based paint.
Well, again, my point being is that realtors often will look at that or hear about it and like, you know what, this isn't going to pass FHA appraisal, and so, you know, maybe that's not such a great idea. So from your standpoint, what do you have to say about FHA appraisals?
They're not a whole lot different than conventional.
Yeah.
It's been back in 22, I got a string of subject to conventional appraisals. Subject to means something needs to be fixed.
Okay.
And they were peeling paint on conventional loans. And I had a realtor just, absolutely lose their top. They were so mad. And so what we found out is that year's appraisers continuing education was about health and safety, and lead-based paint that is peeling is exposed lead to anybody that's around it. That therefore is a health and safety issue. So therefore the paint had to be scraped and painted.
Absolutely.
Straight up health and safety. I had another appraiser or realtor lose the small mind that they had. If they shook their head 3 times, it'd have rolled out their ear and I wouldn't have to deal with them anyway. But they had a porch that had no porch light on it and just live wires sticking out of the porch.
That's not okay.
And the lawn was more than knee high.
Oh.
So the conventional, and they had a window that was broken in the back. So the appraiser marked on it, window must be repaired due to egress, meaning the property could not be properly secured.
Correct.
Those wires had to be capped or a light installed because they were a fire hazard.
They are.
And the grass had to be mowed.
Safety issue.
The grass had to be mowed did make me call the appraiser and say, what? And he said, well, if you close this within the next 30 days and the city sends somebody out to mow that lawn, that mechanics lien is going to take 45 to 60 days to be recorded on the title. And your new buyer is going to have a $500 to $800 mechanics lien that they have to pay for the lawn to be mowed.
Wow. Yeah. I honestly thought of a safety issue, you know, things living in the long grass that maybe you aren't aware were there. Yeah, exactly. Right. But yeah, I never thought about the lien.
Mechanics lien if the city mows it.
Yeah, for sure.
So the realtor on the listing side went, fine.
I'll go cut the grass.
All right, so here's the deal. You don't need 20% down. You don't need perfect credit. And you definitely don't need to wait 5 more years to buy a house you could have already been living in. Whether it's FHA, conventional, or something else, there is a loan that probably works for you. You just have to ask the right questions and stop assuming the worst. If you've got questions, I've got answers. Drop a comment, shoot me a message, or just yell into the void and hope I hear it. And if this helped at all, hit that subscribe button so the algorithm gods will bless us both. Thanks for watching.